Our guest today is Jessica Wirth Strine, the CEO and managing partner of Sustainable Governance Partners. Prior to forming SGP, Jessica worked at Vanguard as senior director of the investment stewardship team, overseeing the proxy voting and engagement efforts. While at Vanguard, Jessica also led an interdisciplinary ESG working group. And prior to that, Jessica worked on the buy side in active equity portfolio management, most recently at BlackRock and previously at Putnam Investments and Wellington Management. We're going to talk about the wild events of yesterday for the fossil fuel industry, ExxonMobil, Chevron, and Royal Dutch Shell. I'm Brock Romanek, today on Zippy Point. So Jessica, a huge day yesterday for corporate governance, ESG. In my lifetime, I think this is pretty much the biggest event that's happened. Perhaps if that Disney lawsuit in the executive pay area came out with a different result 15 years ago, that might have been the seminal event. But for right now, this really has a lot of meanings to a lot of people. But let's start with ExxonMobil, because there were three different things that happened yesterday, and that sort of magnifies the moment, I think. But can you talk a little bit about how long the proxy fight lasted, the level of resources invested, and sort of the background there?
Sure, and I agree. What a big day, right? And we each come at this from different angles, so it's good to bring them together. Having followed the industry for a long time, I don't think that you could have seen this coming 20 or even 10 years ago, but certainly there's been a lot of momentum behind different areas of interest and different forces coming into this that really coalesced yesterday, and some surprising outcomes. I mean, for starters, from where we sit, and I think everyone else who has been watching this, it has all the makings of like a Netflix series, and I can't wait. Maybe you'll play a supporting or starring role. Maybe I'll get a cameo. Who knows? We'll be involved. But what a thriller, right? A tiny hedge fund, an upstart hedge fund, takes on the big unit, ExxonMobil, the world's super major, and goes after four seats, and incorporates climate change in their contest, in their campaign, as a major feature, obviously. They and the company combined, I think we know, have spent well over $60 or $65 million on this contest in the series of quarters leading up to this. During that lead up, we saw Exxon change out three directors or bring on three new directors. We saw them announce a low carbon solutions unit. They updated their GHG emission targets 2 days out. We saw, I think, Sunday night or Monday morning ahead of the Wednesday meeting, they made a promise to add 2 more directors within 12 months. So all of this really in the lead up to what happened yesterday, but leaving us all kind of Tuesday night, Wednesday morning with the big question: was this going to be enough for Exxon investors, right? And as we now know, 24 hours after the meeting, the results say no, not exactly, right? Preliminarily, and we'll get into this. Of course, we see that we've got at least 2 new directors coming on. Two of engine number 1 nominees have garnered more than 50% support. I think we're probably both waiting for that final tally. I don't know if you have any preliminary thoughts on that. I'd love to hear what you're thinking, but it sounds like we may have more information, but I don't have any scoop there, but I think we'll know more when we know more. But we also had 2 lobbying proposals pass, right? Which is important to think about too. But what's your reaction to the result?
Yeah, it'll be interesting. The Form 8K with the voting results is due 4 days from the meeting, and with day 1 being counted as the day of the meeting, the Form 8K can be just the preliminary results. So if that one race that's too close to call is still too close to call, that would be very unique, but it might happen where we get sort of results for 3 of those seats in the 8K, but the 4th one, they're still going to be doing tallying beyond. And then the 8K would have to be amended when the company knew for sure what was happening. Yeah, the amount of money being spent is just mind-boggling. As I understand it, for those, I was on Twitter following it, and questions were being asked, who's live tweeting the meeting? And I didn't quite see any of that, but I did see a lot of tweets about when the company did delay the meeting for an hour. They said they needed to do that to collect votes because votes came in so late, but probably votes were, calls were being made to try to flip votes. And that's a hard thing to do. Let me talk for a second about the proxy mechanics of how that works. Electronic voting for annual meetings is cut off at 11:50 p.m. the day before the meeting. So if a beneficial holder wants to flip its vote on the day of the meeting, it's a really difficult process. They have to do something called a legal proxy that would then be submitted directly to the tabulator at the meeting itself. The legal proxy, if properly submitted, must be requested by the holder, so its custodian passed through to the intermediary, which is likely to be Broadridge, is then submitted to the company before the polls are closed. So it's a manual process. It takes hours to accomplish. And so the polls would have, for that to happen, would have had to kept open for hours and hours if the company was expecting a flip vote or perhaps adjourning the meeting. So in my mind, if there had been people at this meeting, if it had not been a virtual meeting, that would have been even made for a much more interesting meeting as of what happened at the meeting itself. Of course, now after the meeting's over, all that sort of old news and just a little bit of drama that doesn't play a role going forward.
Yeah. So it turned out, I mean, just from where we were sitting, in the stands, waiting for this vote to come through, all of this anticipation, it was a nail biter, right? Because, and I guess it still is, where we know that two seats will change. We have, some indications that there might be something more than that, but we're not sure. But maybe, I guess, taking a step back to all the drivers behind this, why did this happen, right? I think that's probably important. You asked me earlier, kind of about the lead up, or, when did this start, or how did this progress? And, when we look at the situation where we sit at SGP, we think this started a long time ago. This isn't just about this contest. And I think it's important to, of course, to acknowledge that we are in the middle of a very different proxy season, and investors' willingness to lean in on certain issues has certainly gone from, a 2 to a 6 or something like that in 2021. I think that this is not just that. This is a company that, for all of its strengths, for all of the amazing talents of its board, for a range of reasons, hadn't established the right tone with investors over a series of years. And I'm reflecting that from the bulletins that we're reading and the collection of responses that we're gathering around the investor audience. And it just feels like there's a very clear refrain from that institutional investor base, that they hadn't felt like they were heard for many years and until recently. And I think that there may have been a bit of a disconnect, and I'm not sure where that derived from, other than to just say that the engagement strength, the engagement rapport, that relationship with the institutional investor didn't seem like it was on Exxon's side coming into this until maybe more recently. There has been a pretty now relatively long-standing pattern of really spending time with that institutional investor, making sure you understand what their priorities are. For a long time, that was about the G. Now it's about the E and the S as well. But it's about that two-way dialogue where the investor feels heard. They see the evolution of your board and your disclosure protocols and your governance practices tracking against their own preferences, their principles, and their own investment priorities over time. What we're hearing, about this situation is that was a chief consideration. That the investor base didn't feel like they'd had that much receptivity or that much board access over the years, and that led them to, I think, be more inclined to consider the case for change at this company. So I think important to kind of take that into account, because we're seeing a lot about how this is about climate, right? And absolutely, that was the tip of the spear, I think, for engine number one. And it got it's getting a lot of attention in the press. It's a priority for some major investors, but for a longer time than we've been talking about climate, we've been talking about board access, we've been talking about investor engagement, and there have been opportunities for companies to really differentiate themselves or not. And I think that was one of the sort of headwinds that started years ago, unfortunately, that didn't help coming into 2021 with this context. Does that make sense?
Well, definitely engagement matters. And, now that you're talking about it, I can honestly say, I don't think I've ever met anyone from ExxonMobil or otherwise had any communication that I can remember. And that's saying something because I've been around a long time and I've been out there. I go to a lot of events. I've emailed with a lot of people in the community over the years. And so that to me is always a little bit of a warning sign. So let's talk about some of these shareholder proposals. ExxonMobil did have 2 climate lobbying proposals on the ballot that did receive majority support. I know some other companies, Norfolk Southern and Phillips 66, have also had similar proposals that received majority support this proxy season. So what you said about this year being much different about climate for those companies that have already had their annual meeting, which is the bulk of them so far, we really see quite a different voting pattern than we've ever seen before. And think we'll see that going forward. So let's talk about Chevron, because they did have a scope 3, what I call scope 3 shareholder proposal on its ballot yesterday as well. And that's another piece of the news that we got that did receive 61 support. And scope 3 is pretty big. That's when the customers and suppliers of a company that has been asked to reduce its greenhouse gas emissions for them to work on up and down the food chain. What would you say about that?
This is a really interesting one too, Brock. I'm glad you brought it up because not only did this proposal from Follow This pass at Chevron yesterday, it also passed at Conoco and at Phillips 66. In fact, at PSX, I think it got 80% support, which is just unprecedented. And as you know, what's really important to keep in mind about this proposal in particular is that this pertains to scope 3 emissions. Like when you or I gas up the truck and go on a vacation and we emit GHGs on the way, that's Exxon's or Conoco's or Chevron's or PSX's scope 3, right? And so historically, the companies on the upstream side and the refining side have been reluctant to set targets around scope 3 because it's outside of the span of control of the company. And historically, it's felt like the investor base has been, at least in the US, okay with that until relatively recently, where we've certainly seen scope 3 come into the range of acceptable target setting demands, right? And so here we've got, statements like we had from BlackRock today saying that they expect companies in carbon intensive industries, not just oil and gas, to assume responsibility for the complete emissions profile of the company. So scope 1, 2, and 3, as the world transitions to a low carbon economy. This feels like a pretty meaningful shift in sort of where the responsibility is. It's kind of clearly placed on the company, the responsibility for managing the energy transition all the way down the food chain to us turning on the heat or driving to Vermont for the weekend. So anyway, I think this is, we're on this trajectory, but this kind of acceptability, these high pass rates for proposals that bring scope 3 into the fold, into the company responsibility range, are pretty meaningful.
Yeah, the rubber is going to hit the road, and how do you actually do that? And so the proposal doesn't obviously get to that issue because that would probably be a binder that's yay big.
Yeah.
Let's talk about the court case now for Royal Dutch Shell. Not that I'm an expert in Dutch law. This was in the Hague District Court, but I think this might end up being the most meaningful of the 3 at the end of the day, where the court ordered the company, which Shell is considered, I think, to be one of the more forward-thinking energy companies, that its emissions reduction plan wasn't enough, that it needs to cut GHG emissions by 45% by the end of the decade, 2030, compared to the 2019 levels the company's going to appeal. What sort of meaning do you take from this case?
And well, I'll start with the same disclaimer that you did. Definitely not an expert on what happens in a Dutch courtroom and what will happen in the appeals process, which I imagine will be lengthy. But I think that the bottom line takeaway from where we sit is just that what this means is it lends a lot of support, a lot of credence to the investor mindset around regulatory and legal risk as pertains to climate change, right? And so, a lot of, when you talk about financial materiality or just materiality of E&S issues in particular, obviously one of the considerations is, if this company doesn't manage this risk appropriately, do they have exposure in the court or through, impending or potential regulation that would impact intrinsic value of the company, because it would cost them more to do the thing that they're doing, or they'd be exposed to fines, or whatever it is. This will be a proof point in those types of discussions, right? When investors are saying, you could be exposed to legal or regulatory risk such as this. So I think that's where it really becomes significant. But I do think we have to be careful about how much we extrapolate from this ruling, given, as you say, it will be appealed, and I don't think we know what the final outcome will be at this point.
And then I thought we'd share a couple of pointers for those companies that aren't in the fossil fuel industry, or maybe some that are. My first one is that the size of your war chest might not matter. You had 35 million reportedly spent by ExxonMobil here, and they did not win. Now, the other side reportedly spent 30 million, and that was a lot on that side too. But these are pretty big numbers, and yet, at least for two of the seats, ExxonMobil lost. What are some of your pointers, Jessica?
Yeah, I think that the point that you make is so interesting, right? Because again, this Daniel Goliath thing, who knew that this could happen? But it feels like it's this merger or this new lane of activism, right? Where you bring together issue activism and hedge fund economic activism. And I think a pointer that we would suggest is high priority is to really be thinking about what your vulnerabilities are in this new lane, where there is, decent evidence or concrete proof that there is interplay between ESG and EPS long-term, right? So thinking about those vulnerabilities. I think the other one is that board composition, even when you have a board that looks like rock stars, has to be approached from multiple dimensions, right? This is a board of luminaries, of leaders, and some of the most impressive profiles I think you and I run across as a group of leaders. But one of the other kind of headwinds coming into this year, I think, was that for many years, some of these investors have been saying that the board lacked industry expertise. And I'll speak from my experience as an energy investor over the years. One of the primary inputs to that DCF model is the oil price, right? And it's, where's it going to go? What's OPEC going to do? What did Mohammed bin Salman have for breakfast? It's all about the macro, right? And so it's not just about having C-suite stalwarts. It's about having some degree of confidence about which way the wind is going to blow, and which way the cycle is going to shape over multiple years. And I think the critique anyway is just that lack of energy industry expertise was not helpful, was seen as a vulnerability by these investors. And so when you bring a slate that has some credible industry expertise, in addition to the ability to address some of these other concerns that they're making a case about, it's hard for some investors who've been saying there's no industry expertise here not to consider that slate. So anyway, just really thinking about the board composition from multiple dimensions.
Yeah, and then what you say in your soliciting material, some of the accounts I've read in the mass media is that ExxonMobil claimed that some of the candidates for engine number one didn't have, C-suite experience, didn't have energy experience, but they did. So to the extent you're being misleading in what you're saying, you're going to lose credibility, because from what I read, that really for people who knew the engine #1 candidates and are like, well, what they're saying is not true, then what should we believe? Anything you're saying is true. So I think you have to be careful about how far you go out when you're making your argument.
I think that's right. I think that's right. And and with any of these fights, you see it all the time. There's a lot of this, we said, they said, and the investors have to decide at the end of the day, who do you trust? Which narrative? It seems like it fits the fact pattern most appropriately. But yeah, I think those are some important ones. One other I'd offer while we're still on this is just this. You've seen this this season as well. Like investors are voting for change rather than quietly engaging and using this behind the scenes diplomacy effort to drive change. Right? BlackRock has written about this, I think, fairly extensively. They're saying that they've done some research that says voting for change drives better outcomes than engagement. And so, whereas kind of in the rearview mirror, it felt like you had more of a grace period, more time to address investor concerns. It feels like that window of time, that time frame has collapsed, and you're going to see more action at the vote than you have in the past.
Yeah, and you had both BlackRock and Vanguard putting out a vote bulletin and a vote insights, respectively, explaining in 3 pages why they voted the way they did. And the transparency there is remarkable, and I think we're going to see a lot more of that. Do you think we're going to see more of these smaller activists that could be hedge funds, they could be LeBron James, Beyonce, could be a celebrity, becoming more active and something to be on the look for?
I mean, if you asked me 4 years ago if I thought we were going to see more SPACs, I would have said no, Brock. And I would have been very, very wrong. And that's not a fitting analogy. But I mean, if you'd asked me 2 weeks ago if I thought we were going to see more engine #1 lookalikes, I probably would have not dismissed the idea, but doubted it, just because look how much they've had to spend. Right. And what an uphill climb, and how many of these things do they have in their arsenal? I don't know. Given the outcome of yesterday's meeting, I could see there being more support for the idea, more capital flowing toward this kind of idea. So I wouldn't doubt it as much today as I did a couple of weeks ago.
And then you have greater collaboration among investors. Climate Action 100 plus is 52 trillion in assets represented. So 30 million looks like a pittance compared to 52 trillion. So maybe the money is to be found.
There you go. Yeah.
Well, thank you so much, Jessica, for doing this sort of by the seat of our pants the day after these events transpired. And I look forward to taping more frequently with you.
Likewise. Thanks, Brock. It was really fun.